Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our EIA show, and we're going to talk about what happened with the numbers, and we're going to break it into our normal 3 segments. So in the first segment, we want to look at crude and Disty. They had a build. What does that mean? And realistically, distillate is still increasing at a normal rate of change, which is a bit concerning just given the levels are so low. So we want to look at what that means. Gasoline starting to flatline, as we've been talking about, as we had a nice increase in imports. And then when we look at Russian discounts, they continue to grow. And what does that mean for not just the U.S., but the market shifts in general? Then in the second segment, we want to look at U.S. refined product demand, what is happening, and how is driving season starting up, and what do we see coming going forward. And then when we go in the last segment, we're going to look at different crude grades, what pricing are they at, and how diesel margins continue to hold up and remain the biggest driver when we're looking at crude quality, just premiums versus discounts. So now we like to start out looking at the total oil and product stocks. So here you can see that the deficit widened from 119.6 to 131. It looks worse than it is when you look at some of the different pieces, but realistically we continue to hold just outside that cloud, which is what we've been saying is we're going to kind of stay within a fairly fixed spot when you're looking at on a global level total oil and product stocks. Crude stocks land and floating, the deficit widened from 50.8 to 53.1. And a lot of that is being driven by the floating side. So if you remember what we were talking about when we're looking at the floating market is going to be have a lot of movement within it as we have a bigger increase in crude oil in transit. And a lot of that is being driven based on the Russian flows and how that is kind of shifting the market in general. And it's something that we have a couple slides on in segment 3 because we want to dig in a bit in terms of what are some of the Russian movements mean and how is that changing the landscape when we're looking at the floating side versus the transit side. Total oil product stockpiles, the deficit widened from 68.8 to 77.9. That's something that when you look at the backdrop, gasoline continues to build. That drop was driven by middle distillate diesel side, which again continues to be in a very bullish spot when we're looking at the different backdrops. And we want to break down some of the different areas. Now, last week, because the EIA show was on Thursday, we were able to put real-time data for the Europe and Singapore. So we won't have those numbers today because they're the same as they were last week. But then we'll have them updated as we go into next week. Now, one of the things that we want to look at is Russian Urals and ESPO crude are selling on the spot market at a discount to around $40 a barrel. And it's interesting because you're starting to see ESPO really run to that number, which is what we had been talking about, where they were trying to keep ESPO, which is coming into the Pacific when you're looking at the east coast of Russia. But again, China's sitting there going, well, I'm not paying a premium for this if I can go elsewhere. So again, we've seen that run down, and that's not something that is, I think, crazy to see. But then when you look at the different crude grades, so Nigeria's Egina crude for July loading is being offered at $13 more than dated Brent because it has a diesel-rich grade. It has a lot of that middle distillate cut within it. And we're seeing that piece in terms of some of those different, the different perspectives on what crude grades are being run, with the middle distillate again being the focal point. And we'll talk about margins and why that continues to be the case in segments 2 and 3. So a record volume of Russian crude is on board tankers with an unprecedented amount heading to India and China, which again is not surprising, but that's also creating this disconnect between what is in floating, what is on land, and what is in transit. So here you can see that the land storage, the deficit widened from 86.1 to 89.2. And a lot of that was created based on the west of Suez, with the deficit widened from 66.2 to 71.9. And that was really driven based on what happened in the U.S. as Europe did have a small build. That has come down a bit. So again, it's just going to stay within a fairly fixed point. When you look at land storage in west of Suez, we just expect it to go sideways, really kind of hugging the bottom end of that cloud. And as we get into August, that's where the comps get a little bit easier. East of Suez, the deficit narrowed from 27.2 to 25.1. But when we look at what's happening in China, we're going to see that decent drop in floating storage. And it's just going to be a matter of when do those cargoes get replenished, and how quickly will they, just given that they're coming from such a long way away when we look at those movements from Russia. So floating storage total, here you can see that the surplus narrowed from 28 million to 9.2. And the biggest driver of this is when you start looking at the deficit widened in west of Suez, went from negative 1.9 to 7.3. A lot of that was, again, driven based on some of the shifts that happened in Europe and the U.S. because West Africa continues to be at a record level. So that deficit is really being driven by the European front in terms of just timing flows. And you can see that it's still above where we were in 2021. And again, it would be if West Africa were able to clear a bit better. But again, it's based on crude grade. You'd see that drop faster. Where east of Suez, the surplus narrowed from 24.4 to 16.5. And a lot of that was driven by China. As they come out of their lockdown, you're starting to see that acceleration, and they're pulling stuff off of the water. But again, it's just a matter of when does it show back up and start to see some of those shifts. Now, one of the bigger shifts that we're looking at that is going to become more and more important as we go through key burn periods is going to be the spread between high sulfur fuel oil and ultra low sulfur and very low sulfur diesel. Because right now, when you think about Pakistan and other emerging markets, they're trying to run the cleaner grade. But as the discounts widen, it's going to become a much harder, and you're going to see that the higher consumption of high sulfur fuel oil. So just to put that into perspective, high sulfur fuel oil discount to crude is on course to plunge to its widest in more than 2 years in Northwest Europe. And the problem is the shifting flows, where as that price drops, we'll see more of it going from Europe into the Asian theater, as well as from Singapore. You're going to see middle distillates start to increase as they start to pull heavier on the heavy resid, the resid and the heavy disty, again, just because it's going to become a cost situation as the need for air conditioning and electricity consumption increases. We do expect to see some of that displacement. But again, even though we're going to see the displacement, middle distillate and diesel in general remains in such a bullish point that even if we start to get builds, it's going to take a lot to see some of the bullishness come out of that market. Now, crude stocks had a build increased by 2.03 million. That's still 97.9 million below the 5-year average. And all of that was really driven based on Pad 3, which had a build of 8.05 million, which is 22.4 million below the 5-year average. Pad 1, again, is going to be fairly fixed. We don't see that adjusting too much. The biggest shifts is really going to be, again, in Pad 5 based on the lumpiness. Pad 5, you had a drop of 2.99 million. That's only 8.7 million below the 5-year average. And again, it's just going to be a matter of timing as to when the imports come in. Because when we look at imports in the U.S. were actually down 64,000 barrels a day, with Pad 3, again, still seeing the weakness on the import side. The big build was really driven by that big drop in exports. And that's why we talk so much about the importance of the 4-week rolling average, just because there's going to be a lot of lumpiness, just based on, as we talk about the geography of the U.S. and the ability to get things in and out. Now, the aggregate for the including the SPR, it dropped 5.24 million barrels. So again, that's just when you look at what the amount of crude going out from the Strategic Petroleum Reserve, and it's just the mixture between the SPR and the commercial as production continues to remain firm. But as we get to the end of June, we do expect to hit that 12 million barrel a day mark. Now, when we look at runs, you can see that there was a big spike in activity, increased by 1.6% back to 94.2%. So remember what we were saying is we expected to get to about 95% by the end of June. So right now we had that quick run up, and it's really just given the distillate cut, where refined products are. We got to this level pretty quickly. We do still expect to see 95% at the end of the month, and we'll give you some idea on why that's the case. But again, it's just nice little the increase, and then I think we're going to hold this level and then have that slow grind back to 95%. None of this is seasonally abnormal, and when we'll look at the seasonality chart, and the biggest driver of this was Pad 3 and Pad 5, and we just expect them to remain at these levels and as we come into that core driving season, with the focus on obviously creating gasoline, but also addressing and trying to capture that middle distillate cut. So here's where you look at refinery utilization. We wanted to break out just so you can see we are at the higher end against the last several years, but nothing that's abnormal. We're right where we were in 2017, below where we were in 2018. So you can see that when we say that 95%, there's precedent to have that as refiners continue to operate at an optimal level, trying to again capture both based on just how healthy the margin is in the market. Imports dropped by 64,000 barrels a day. The drop was driven by Pad 1, which had a drop of 127,000, where Pad 3 had a drop of 157,000 barrels a day. Pad 3 was the one that we were expecting to stay at about 1.5 million. Now the imports are 1 million below the 5-year average. Again, that's where, as the distillate cut starts to become the bigger focal point, or I should say starts, but really remains the main piece, we do expect to see those imports remain elevated. The question is going to be price. What is the price that we're getting? And as the premiums continue to remain elevated, especially out of the Middle East, we do expect to see more of that West African grades start to come into the U.S. markets. Pad 5, as we were saying last week, there was that drop. Again, the lumpiness is there. The Pad 5 increased by 206,000 barrels, still fairly stable for this point in time. Pad 2, Pad 3 import data, we were expecting this to move a bit higher and bounce back up. Instead, it dropped again. There's that mixture because we did get a decent build. There's probably some lag in some of the data. So we should see this again bounce back up, but not like it's going to go back to the 5-year average, but just back off from those lows. Now, Pad 2, as we were saying last week, we expected it to continue to increase. We don't see that changing. Again, we expect it to remain well off of the 5-year average and remaining at the top end of that cloud, just given the grade that's coming down and the importance it is for refining at this point, especially when we're talking about that middle grade. Implied demand, as we said last week, we expected to see gasoline have a nice little bit of a bump, just because we didn't get that increase that we normally get post Memorial Day. And usually when that happens, it means instead of getting one big bump, you get two smaller increases, and that's exactly what happened here. We had an increase of 222,000 barrels a day. That's something that we expect to come back down, but still remain at around the 9 million barrel a day mark, because we are in summer driving season. So you have to consider, where should we be right now versus where we are. And it's something where we expected it to come up to about just over 9 million, but then really start to flatline and not get the same type of move that we've gotten the last 7-8 years as we come into that summer driving. Distillate had a drop of 319,000 barrels a day. This is just, there was that refill post Memorial Day. Now we get a little bit move lower, and the freight market continues to show a lot of cracks within it, which is something that Freight Alley has been talking about, or Craig Fuller on his YouTube channel, as well as on his Twitter, which is a place that we look at and we talk to a decent amount when we're looking at the underlying freight data, which continues to be fairly soft, and we don't see that changing too much versus last year. Jet, back to that range that we've been talking about that 1.45, 1.55, again, something that we think holds firm. Resid continues to fall back to that normal range, and propane, as we were saying last week, we got that nice bump. And we expect that to remain strong given the heating, the cooling needs that have come into the market, and just the heat wave that we're seeing come into this shift. U.S. imports of gasoline from Europe remains robust. They did fall to a 3-week low, but again, that's the timing delay. And we do have a decent amount of gasoline still coming into the market, which we'll talk about in a minute. Gasoline implied demand. Here you can see that typically you get that bump and then the fade, instead of getting that fade as we had in 2020 and 2021. Not 2020, I'm sorry, those 2015. You can see that there's that normal drop, and then you get that nice bounce, and then that bounce is when you start to hold in at the higher high. We're just expecting to see that bounce and a small pullback to and then just really remaining below that normal. You can see, even though there's typically a bump this period, we just don't expect to see that come through. And again, staying off of the normal seasonal increase. It'll still be at the high for the year, but it should be higher given where we are in the driving season. Instead, it's going to be the high for 2022, but the low when you look at the last 7-10 years of activity. And all of that is being driven based on pricing, which we'll talk about in the next segment. Now, when you look at crude oil inventories, excluding SPR, flat, we don't see them going up or down, just essentially remaining in this level. When you look at days of supply, it dipped. It should dip again, just because refining activity has increased so much, and it's going to really hold to that 2018 level. And then when you look at total commercial oil storage and products, little bit of a bounce. Again, we just expect it to stay fairly fixed at this point, and we do expect to see a bigger increase in gasoline and distillate, but the distillate increases will just be very seasonally normal, and we really want to see that acceleration, but we're going to talk about that more in segment 2. So here, when you look at gasoline storage, it's starting to flatline. As we were saying, it should. You get this flatline, then you're going to start to get a bit of an increase, and that's going to be driven based on the imports coming in and just the lack of demand, because there will be demand. It just won't be the same normal seasonal demand. So refiners ramping up, imports increasing, and demand remaining flattish versus the normal seasonal bump will start to push this a bit higher. Now, when we look at distillate, this is what we were talking about. We should be getting increases in storage right now, but you can see it's very normal for this time of year, which is a problem because normal isn't what we need. We need something faster than normal to ensure that we have enough product as we get into that core period of September, October. So this is going to be one to watch. As jet fuel, again, just going back to the normal level, there's really not much to say one way or the other. Where jet fuel, the kerosene versus distillate, do you leave it in the diesel pool? Do you pull it out for jet fuel? And right now, they're just moving things back to the average. On the crude futures curve, you can see that we're above 110 essentially into the end of the year. And then when you look at above 100 into the beginning of next year, the biggest and the most important piece is we still are holding above 65 as we go through the end of the curve. And one of the things that we've been talking about is we thought the belly of the curve offered the most opportunity. And you can see there's been a big shift in that, in let's just say the December of this year, December of next year. And that's, I think, where we're going to continue to see a lot of growth and a lot of premium come in. and that's where the front month is going to waffle back and forth. But again, it's that belly of the curve where there is a lot of staying power when we're looking at some of the different value to be found in trading the curve. COVID in general, worldwide, something fixed. I know personally people that have avoided COVID for the last two and a half years is now getting it. I think that's pretty consistent. Asia Pacific fairly flat. We don't see this as really a driving force at this point, especially as China reopens. Again, China is the one that still is holding to the zero COVID policy. So that's going to be the key to watch when you look at increases in cases. But so far, things are continued to reopen. Crude oil inventories in Pad 3, again, as we were saying last week, it's going to be fairly flat. We had a sizable drop. Now we have an increase. Again, it's just going to waffle back and forth and really hold this level. Now, when we start looking at Cushing had a nice little drop, still off the lows from 2022. We just expect it to hold sideways at this point, but again, still edge higher as we do get a bit more activity from U.S. production, as well as a bit more imports. And again, that's going to be that target for that middle distillate cut, which will leave a little bit more in Cushing storage. Now, when we look at floating storage, here you can see that there was a sizable drop, still seasonally adjusted all-time lows, which is why the import data, we do expect to see this increase. It could be timing, could be a lot of things. But again, that's where we do expect to see a bit of an increase in Pad 3 imports. And it's just because we saw this drawdown. This is, again, that timing delay between the two. But again, we do expect to see that increase a bit. So that's what we have for you on the holistic side. In the next segment, we're going to go deeper into U.S. refined product demand supply. And then segment 3, we're going to go, into the broader market.